Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Thank you for tuning into my video today. What I'd like to discuss and run through in this video is a recently announced change to land tax in Queensland. So if you own property as an investment property in Queensland and other states or territories, whether you're an expat or you're an Australian resident, this is a very important video for you because it may impact your cash flow in quite a substantial manner. So in this video, we're going to run through exactly what the change is, how it could impact you, and what you need to think about going forward to minimize the burden of this change. So let's get started. So what has actually been announced? From the 30th of June 2023, the Queensland Government has announced that land tax will apply based on the overall assessable value of your Australian land. Now, what the rules are currently is that it only applies to the value of your land, your assessable land in Queensland. This is a substantial change for anyone who owns multiple properties in Australia, because now the values of all of that assessable land are going to be accumulated as one, and they'll need to be reported to the Queensland Government. Now, the tax that applies will still only be based on the Queensland portion relative to your total land value, but it may push you in a much higher tax band and may push you outside the tax-free threshold. Each state and territory in Australia does have its own land tax-free threshold. They do get revised on a fairly regular basis. In Queensland, it sits at around 600,000 at the moment. Now, for anyone who's not already paying land tax or hasn't been filing this and declaring the value of their land to the tax authorities, this is certainly something you need to start doing some homework on, as I said, particularly if you do own multiple properties. So that's what's been announced. Let's have a look at how it could apply and have a look at what you should think about doing about this. So let's just say, for a very simple example, that I own one property in Queensland with an assessable land value of 700,000 and a property in New South Wales with an assessable land value of $1 million. Now, my total land value is 1.7 million Australian dollars. And by the 31st of October each year, I need to declare that in Queensland of my overall Australian assets. Now, we can see that the land tax that applies to Queensland will be based on the $700,000 portion of the 1.7 million, but the total assessable value and the tax bracket that actually applies will be based on the 1.7 million. So where I was only just outside that tax-free threshold previously, I'm now well outside it, and that could in many cases result in my land tax bill doubling, tripling, or even quadrupling. So this is certainly something not to be ignored, and given that we've got about 12 months to plan for this and prepare for it, it's a very good time to get started. Now let's have a look at what we can do about this, what we should do to prepare for it. So there are a couple of things that we can consider. First and foremost, it's very important to be aware that we can't simply deduct land tax away. It has to be paid. It is a tax deductible expense. So speak to your accountant, speak to your tax agent or your planner on this one, because it may create some additional tax deductions that you can utilize in future. So that's the first one. Just plan for the future tax implications and what they may mean for your future tax affairs and future net income. The second one, which is a very simple one, is to simply plan for the increased expense. It is coming into effect from 30th of June 2023. The rates are fully disclosed, so there won't be any surprises with how much you own other than what the assessable value might be. So you can already start getting a pretty good idea of what you will owe the tax office when it comes to your land tax bill. So make sure you've got that money set aside. If you don't, and you don't think you'll be able to, consider, again, refinancing your loan, increasing your loan balance, setting up a line of credit or an equity access loan that may allow you to use some of the equity in your property to pay that land tax in future. Just make sure that you've got a bit of a plan and are ready for this additional expense. Now, when it comes to future purchases, so we know there's not really a great deal that we can do when it comes to our existing assets. You may want to think about changing ownership structures. If you own a property in joint names or your individual name, you may want to think about shifting that into joint names, shifting into a company, self-managed super fund. But in most cases, this is going to result in stamp duty and capital gains tax, both of which will often make this a pretty redundant consideration, but certainly one that you should at least give some thought to and review. Most importantly is to prepare for what we do next. So when we think about buying our next property, refinancing, whatever it may be, it's important to realise that land tax is still based on each individual entity. So in our own name, we get a land tax-free threshold. In our company, in our trust, etc. and so forth. So you may want to think about setting up different structures to own your future properties to start to minimise some of this land tax. Be aware, this may not be a guarantee forevermore because this is obviously quite a substantial change. Queensland is the first state or territory to actually apply land tax based on your overall Australian land value. So do be aware that things can change, but certainly give some thought to how you own your future properties going forward. Whether you're an Australian expat or an Australian resident, certainly seek some tax advice here and consider what's possible. I would also suggest reach out to your mortgage broker and make sure that there are no issues when it comes to lending to those different structures. Now, I realise this is quite a complicated change, particularly when it comes to tax and planning for tax. It is going to be quite a financial and administrative burden for a lot of people that do own multiple properties in Australia, but thankfully you've got 12 months to plan, or very close to anyway, so make sure that you get on top of this, put your plans in place and be ready for this tax change. If you have any questions at all, drop me a note in the comments, reach out to me directly, more than happy to have a chat. Thank you very much for tuning in. Please remember to subscribe and like the video, and I look forward to seeing you next time.